The apes seem to think that Wall Street's robbing you somehow by shorting AMC and GME. Now that's misguided and stupid because none of you have ever actually opened a 13F, but there's actually an easier way to rob you. And to make matters worse, it's been around for so long that it's actually in the letter of the law in some places. So you'd ask, how do they do it without you noticing? Well, I'll tell you. It's actually through your pensions. I'd like to ask that you hold back your outrage for a second, unless it's to hit that big red subscribe button, that like button, or to share this video. The more exposure this video gets, the more you can actually hit them where it hurts, in their bottom line. To start, show of hands on the like button. How many times have you heard or have you said yourself, it's just a 1%, 2% fee, it's not a big issue? What people fail to realize is a very important distinction. It's 2% of the entire account, not a performance of the entire account. Look, if you're not convinced, ask Vanguard. They found for every 2% you paid every year would wipe out almost 40% of your final account value. To add some extra salt in this wound, they don't mention performance either, so they could have actually blown up your entire retirement and still collected the fees. Before I show you my first example, I just want to mention that I'm not a lawyer, nor am I a financial advisor that is familiar with your specific financial situation. You should find someone that you trust that is a licensed pro that is also a fiduciary with everything that they sell you, and that's very important. But here we go, here's the example. Back when I was a union boy, this was one of the plans that were offered to me. Interjecting really quickly, where I'm at, legally, they're required to force us into these funds because of the way the law works for some reason. Your mileage may vary where you are. So let's see how I did thanks to Daddy Government. This says, according to this, a person who invested $1,000 is expected to return about $1,600 or about 5.4% a year. Most people would say, what's your problem? They had a 69% return, and here's where my problem lies. This doesn't include the fees. I've already done the math for you, so just follow along. In the blue here, that's your starting 1,000. Over here is your MERS fees, so your management expense ratios. Over here is basically the returns for every subsequent year, so 2011, 2012, and so forth. This is what happens. So after the first year, you're left with $966, or actually, in reality, you're left with $940 after they take their fees. So you lost about 6% for that year. So this keeps going on until 2020, and you're left with $1,200 minus the fees, so $1,250, which brings you out to a total return of 24%, which means that 5% per year claim is actually only about 2.4%. Now, 2.4% per year sounds terrible, but I'm going to make it even worse, and I'm going to make it even less. Blink and you'll miss it, but there's a little footnote here that says that there's an AMS fee of between 0.5 to 1.25% that's negotiated between you and your advisor. The MERS fee is not included in this fee. These are just a few of the fees. There are like early withdrawal fees, there's penalties. What if you lose your job and that specific fund was only for the people who are working at that company and therefore they have to kick you out? Like, your mileage may vary in this case. Now, if this was my family, they would actually pit them against someone better than them to see how they do. So let's go do that. Against the SPY. There we go, back at it again. So let's start with our $1,000. There's no fees per se, and I know there's a little nuance to this, I'll explain later, but let's say $10 for the trade, the most unfavorable one in here. So you paid $10 for that trade, you put in your $1,000 into SPY, let's see how it grew. So after the 10 years, you're left with $3,600, or a return of 143%, or about a 14.37% return on average, compared to the 24% and 2.42, probably less than that, per year going with that managed fund. I mentioned the ETF has a fee as well, and it's right here. It's called the expense ratio, and as you can see, it's kind of negligible. Listen, my point in all this is very simple. What do you think your lifetime of work is worth? Because if you ask these funds, it seems to be about 50% of your entire life's income. I'll leave the rest to you if you want to go asking questions and stuff like that, but, you know, you do you if you don't want to. Just remember, just because you're a day trader doesn't mean you have to trade every single day.